Welcome to our EAG Tax webinar on corporate indexation allowance. So let's rewind to 1998 when indexation was paused for individuals. IA was still available to reduce capital gains at this time, but it was limited to the period from March 1982 through to April 1998. In 2008, without notice, this valuable allowance was removed entirely, inflating capital gains overnight as a consequence. Fast forward to 2017, indexation allowance was paused in December for companies. If the government replicate their previous decision, companies could lose the IA accrued by the end of 2027. In the government's own economic impact statement from 2017, it stated that the costing includes a behavioural effect to account for the affected population finding ways to mitigate the impact of the changes. As a reminder, the indexation factor for companies owning relevant assets since March 1982 is 2.501. This means that a March 1982 value of £100,000 generates indexation allowance of £250,100, attracting additional corporation tax relief of £62,525. I would argue now is the time to review and consider your balance sheet assets. Armed with this information, there may be a number of questions to consider within your management team. One question may be whether the asset is located in the correct part of the balance sheet. Assets which are currently within fixed assets, but which are expected to be sold alongside existing stock, could be moved down the balance sheet to current assets. An election can be made to bring the asset into stock at its current market value, less the capital gain generated at the time of transfer, to ensure a tax charge is not brought forward. Property developers are the obvious sector, but it could impact other sectors. For instance, I have seen demonstrator vehicles included within fixed assets, but sold for more than cost. For those within a group structure, now may be the time to consider whether the asset is held by the correct group member. Single companies may also now consider the benefits of a protective holding company. Generally, group transfers do not trigger corporation tax nor stamp duty land tax, as long as the commercial reasons lead the decision making. It also banks IA on transfer. Remember though that degrouping charges can come into play when the recipient group member leaves the group. When reviewing group assets, other taxes should also be considered. For instance, the inheritance tax relief, business property relief, is not tainted when the property owning group member lets to others within the group structure, but may tip over the wholly mainly test when let to third parties. Another question to consider is the useful life of the company assets. For instance, now may be the time to sell and reinvest in new premises. Rollover relief has long been used to help a business upgrade and also bank valuable IA without suffering corporation tax charge on the capital gain generated. The key assets for companies are land, property, and fixed plant or machinery. Remember, full rollover relief only applies where the net proceeds from sale are fully reinvested. If the proceeds not reinvested exceeds the capital gain, no rollover relief will be available. Restrictions also apply where the asset has not been used in the trade throughout ownership, or where buildings are used only in part for trading activities. Alternatively, the balance sheet review may link with the shareholder's succession plan. Do they know who their likely successors are? Are the current company assets likely to be of value or use to the future owners? Sale and leaseback transactions may be one option where a larger third-party purchaser would look to consolidate activities at their existing premises. The cash proceeds could then be used to invest in cost-saving equipment, helping boost profit margins and potentially in turn the company valuation. Alternatively, the owner may wish to move the property into their personal name or possibly a trust, perhaps knowing that a management team could not afford or raise sufficient finance to buy the company shares with the property in situ. with the appropriate lease in place, this securing an income stream for retirement or perhaps to fund grandchildren's education costs. In addition, with the pension fund limits currently lifted, SIPPs and SASs may now be a viable option to hold particular company assets. Ultimately, there has been no communication from government confirming that they will remove IA for companies, but this is certainly a useful tool to start the conversation within the management team about future commercial plans and highlighting the value of the indexation currently held. Thank you for listening. If we can assist with your business, please do get in touch using the contact details below.